It is about 1 o'clock, so we can begin. So today we will be learning a bit about, we will be introduced to consumer arithmetic. Consumer is spelled this way, and arithmetic. Now, consumer arithmetic is the foundation of applying math to the areas of finance and economics and so forth. And to see this, we can analyze the word consumer. Now, the word consumer has a couple different meanings, being to consume, as we can derive the word consume from consumer. Consume meaning to use. Now, consume most often is used when talking about eating and drinking and that sort of thing. It means to biologically use, which is to eat food. But in terms of economics, consume, a consumer in the act of consuming can refer to multiple things, specifically relating to consumables. Now, consumables are consumable items. So we can say instead consumable items. Consumable items are generally items that can be used. Use a different marker just in case. So consumable items can be used. Now, typically, when consumable items can be used, usually consumable implies a limit on usability. So the limit most usually is 1 use. These would be consumable items because you use them once, like food, and they can no longer be used. Sometimes consumable items have more than 1 use, such as a packet of paper towels that have a limited amount of use, and after a while, the item is consumed and typically another consumable item is used. Now, some items are not considered consumable. They can be considered permanent items, meaning that you can use them forever, say a comb, unless you break a comb, in which case the comb is then consumed because it is made unusable. So another comb needs to be used. So in that sense, a lot of items that can be renewable are instead consumed. But that is what generally consumer refers to in consumer arithmetic. It revolves around third definition, mainly consumer being a person who consumes. Whereas Consumer refers to a person who consumes, and to consume means to use, and you use consumable items, which are items that can be used and typically may be a limit on their use, may be limited in how many times it can be used. So the consumer arithmetic refers to all of these ideas. And this simple definition expands over time to different, more complicated ideas, which is what the math we will go over talks about. Now, in consumer arithmetic, there are a couple things that we go over. There is the exchange. Where exchange refers to usually exchanging currency for goods and services. Now, when we exchange currency for goods and services, the main thing we look at is currency, because currency is essentially money. And this is where all of the math comes in for consumer arithmetic, because money is special. Because what money does is it assigns value. Not just any value, assigns numeric value. And this is important because we can assign a number to the value, it is what allows us to do all this math. So numeric value. Now, this numeric value is how we use all our math, because we say that a certain good or service has a certain amount of value, which we represent through money, its numeric value. So when we use our math, we will be typically using it in terms of money and quantity. And we'll talk about quantity in a bit. Now, a good refers to an object. This object, for instance, would be this marker. What we would do is that we would see with currency, we would assign a numeric value saying this is how much this marker is worth in terms of our currency. So a good being this marker would be me going to a store and buying this marker for a certain amount of money. That is me exchanging currency for a good. A service would be something, a service is, well, a service. It is something that somebody does. So a task, let's say, a task or a job. Now, goods and services go hand in hand because most of the times a service has to do with a task or job, mainly being a job, and the job revolves around the management of goods usually. So a good not only could just be a single item, it can also be a house, for instance, or parts of a house. if you were to say hire a repairman to fix a house, the good would be the roof and the materials used to build rebuild the roof, and the job would be the person who has to use these goods to repair the roof, in a sense. And you would apply this currency, which is a numeric value, to the goods and the job, the objects and the services. So that is how it works. Now, usually, one thing that happens is that currency is the most popular exchange, but there are more than one ways of exchange, in a sense. Exchange would typically refer to the exchange of currency for goods and services, but other things are trade, which could refer to trading goods for other goods and services. Or trade can refer to trading goods or services for goods and services, but usually it refers to trading goods, because one term is to say that your job is your trade. So let's say my trade was being a merchant or being a repairman. That would technically be my trade, which is how people say it, but more often people will be referring to trading goods for other goods or services. So this would be common in like trading toys or commodities like that. So sometimes people trade toys and cards and comic books, things like that. Usually there is some sort of rarity attached to the things you would be trading, and that rarity would be a subjective value that people would trade based on. Another thing that trade happens for is when governments talk about trade deals, things like that. Now, trade deals with governments can refer to exchanges where a government could pay for certain goods or services, or sometimes they trade raw materials like steel for gold, things like that. So trade can refer to goods for goods or services, or services for. Now, usually services are usually not traded for goods or services. Usually services are traded for money, and this would be a reward. Usually a reward would be services for money, and goods, or they refer to agreements. Agreements like contracts and such like that. But in the end, this terminology doesn't matter too much. We merely have to look at exchange, because what we do is that we assign everything a value. And if you're, say, trying to get a car, and you're getting a job so you can afford a car, you'd be trying to provide a service, being your job, in order to get your car, which is a good. So indirectly, you're trying to trade a good for a service for a good. But what you would typically do is you would exchange your service for currency, and then you would exchange your currency for a good. That is the basis of what our math will be about. Now, aside from exchange, there is a second, there's a couple other things that consumer arithmetic will be about, and that is things like profit and profit, revenue, loss, etc. But profit, revenue, loss, etc. all all rely on the process of exchange, because profit, revenue, and loss refer to large-scale economies, such as what you'd find in businesses or government budgets, things like that. Now, the thing about profits from revenues and losses is that all of this is based on exchanges that happen. So this would refer to the flow of money, and the money would flow by means of exchanging currency for goods and services and other monies. So that is generally what consumer arithmetic is about. It is about exchange and all the things that happen from the exchange. And later on in higher level courses, when you talk more about economic classes, focusing on exchange will be referred as microeconomics. So microeconomics. And these sort of things like profit, revenue, and loss, things like that, would be referred to as macroeconomics. Now, economics refers to economy, which generally refers back to consumer arithmetic. Micro and macroeconomics describe how these things interact into economy. Micro refers to, micro is a prefix that means small, and macro is a prefix that means large. So microeconomics is the small scale, which is the exchange, and the exchange is the bottom of everything. And macroeconomics refers to the large scale stuff. So this is the profit, the revenue, and the loss of the companies, which is what everybody focuses about. So this is the idea, the sort of knowledge you'll be thinking about as we go on further into consumer arithmetic. We can talk about this stuff a little later. For right now, we are going to start with exchange. But with exchange, we're going to first talk about currency. So let's start with currency. So currency is it is a money currency is a money that shows value. Now, the thing about currency that gives it its power is that everybody takes currency. Currency by itself has no value. It's the fact that other people will trade currency that gives it value. Now, usually governments, economies, usually try to base their currency off of some product to give it value. So like a government will say, like the US, for instance, the US has famously based their dollars off of oil. So we'll say oil dollars. The reason why is that money is usually based off of the most valuable material that a government can have a lot of access to at the time, so that that the currency has value. So the dollars used to be based off of $1 being a certain amount of oil. And what this did was that because you can pay, you could pay this money to get oil, that means that this amount of money was worth a certain amount of oil. And from this, people would say, they would have a good, like a marker, and they would say, based on the currency being worth this amount of oil, I would say that this good is worth this much oil. So because a marker is worth so much oil, that means it is worth so much money. And they did this with oil, and they did this with gold. And that's what the gold standard was. Sometimes the money used to be made of valuable material like precious metals, gold, silver, that sort of thing. So the money actually did have its own material value, and you could break down the money into its raw gold material and such. But they don't do that anymore because that's really expensive. Now they have paper currency and electronic currency. And the value that this comes from is nowadays, I think the US still uses oil, but because it has been used for so long, people have gotten used to it and they've built the economies around it. So that is how currencies generally work. It is worth money. Money is valuable because people say it's valuable, because they will trade things for it. Now, Guyanese money is in dollars, I believe. And I don't remember every single one, but I know that you have coins and bills. Coins are physical metal bits. You already know how coins are and what they are, but they're generally made for lesser value because they're smaller materials. They can be carried around a bit and they can be used as change. So for smaller exchanges. I believe in Guyana, you have the $1, the $1, the $5, the $20, and the $50, I think. I'm not completely sure. And then I think for bills you have $100, $500, and $2,000, and then so forth. Now in America, we sort of do things a little differently because in Guyana, Guyana has broken down the currency into only dollars. The US does something a little different. They have something called cents. So this is Guyana. And in the US, the US uses dollars, just like Guyana, but it also uses cents. And cents are fractions of a dollar. So what happens is that US currency is a certain amount of dollars, and they have a decimal for a percent of a dollar. So this would be cents. And then we have regular dollars. So for cents, we have coins being 1 cent, which is a penny, 5 cents, which is a nickel, 10 cents, which is a dime, and 25 cents, which is a quarter. They have half dollars technically, but they're not really used. For regular dollars, which are bills, so for regular dollars, which are represented in bills, they have $1 bill. They technically have $2 bill, but they're not really used. $5 bill, $10 bill, $20 bill, 50, and then $100. Now, 1 cent, well, no. The way it is that bills are like the regular currency, and then coins would be parts of a bill. To me personally, I never thought it made too much sense to have the decimal for the dollar, but it is how it is. The regular dollars are what we use more often. You almost never use cents in America, but this is how the U.S. bills. This is how the U.S. currency works, and this is how I think the Guyana currency works. One thing that will be important to you, especially if you are planning on traveling, which I think many of you are, is understanding the exchange of currencies, because countries have different currencies. You need to know what one currency is worth to the other. So let's say you have Guyana money, and then US money. So in Guyana money to US money, I believe the exchange rate, where, let's write exchange rate. Exchange rate is the exchange of one currency for another. So I'll say the exchange of two different currencies. Sorry if it's not very easy to read. But exchange rate refers to the exchange of different currencies. So I believe the exchange rate between the US and Guyana is 1 US dollar is worth 200 Guyana dollar. Let me see if I can write that better. So 1 US is worth 200 Guyana dollar. So this is the exchange, roughly, I believe, that you'd have to remember. It's somewhat easy to remember, but I think the actual exchange is like $206 or something like that. But this is generally the idea. So what this means is that if in Guyana you had a bottle of milk that costed $200, that would be $1. That would be $1 of milk in the US, which I think I heard somebody say that a bottle of milk might be $200 in Guyana. So $1 milk in America, that would be very cheap in America. But this is how it works generally. So exchange rate is something that generally you'd want to look up and see how much money is one country versus another. If you want, you can look up on Google, on the internet right now, and you can look up and you can see how one currency trades to any other currency. That's the easiest part of consumer arithmetic. Now, generally, the math in lower level consumer arithmetic revolves around the actual exchange itself, a currency for a good. And it refers to how we manipulate the currency. So in an exchange, there are three general things that low-level consumer arithmetic covers. It is sales, tax, and tip. Now, a sales is different. Sales are not sale, discount. Discount refers to when a store, for some reason, lowers its price temporarily. So the price is temporarily lowered. There can be multiple different reasons for this. It could be because the store is running out of business, that they try to do it to get more. It could be because the store is actually closing, and that is what closing sales usually are. And sometimes it's for holiday. And what happens is that when something is on sale, you get a discount. And the discount is by some percent, usually. It is either a percent or an actual number. Or sometimes they have deals, which are buy one, get one free, things like that. So when something is discounted, it's generally on sale. So either it's reduced percent, a reduced amount, or a buy one, get one free. And the reduced amount would be generally buy a certain amount of something, and the next one you get at minus something amount, which would be the same as a percent, but it's just less common. So that's what a discount would be. A tax is when the government takes money from you when you buy something. So government payment. Now, tax varies a lot depending on wherever you are, whichever country. I don't know how the tax works in Guyana. I know in the US, the way it works is that the government collects a certain amount of tax from a store. And what happens is the store raises the price of the whatever they're selling by a certain rate, and that is the tax. For in Maryland, where I am, they have a tax of 6%. So if I were to go out and buy this marker, the marker's price would be a certain amount, and then the store has to raise the price by about 6% in order to pay for their taxes. And that is generally how the tax in the US works in terms of consumer exchange. There are other things that tax refers to that do not have to do with this, like individual people's taxes. And that has to do with like services and other things. But tax in exchange refers to the amount that a price is usually raised in order to pay the government with. In countries in Europe and some other places around the world, they have something called a value-added tax, which is the government actually taxing the goods directly. So instead of taxing the store and the store taxes the goods, the government directly taxes the goods and services and things like that. And the implications are different because oftentimes stores can cheat the government and pay less taxes so they don't have to add the tax to the goods. The value-added tax means that everything is taxed regardless. So there's no way that the store gets out of it. But in terms of consumer arithmetic, mostly the calculation is the same for how you do it. What you do is that when a good is taxed, you apply the tax to the price. And the only difference is the system behind it. Tip is optional. It refers to when you pay someone for doing good work. usually paying extra. So for their quality of work. Now, tips can function a little differently depending on where you are, but there are two different ways that tips usually work. Sometimes you tip people who make a decent amount of money. You tip them a little extra if they do a good job. That is when people tip someone because just because it's nice. Something that happens in America, which I'm not sure if it happens elsewhere. I know it doesn't happen in Europe. Waiters and servers in restaurants do not get paid minimum wage. They don't get paid a salary like most other people do. What happens is most of their money is made from tips, and I'm a little biased against this practice. What happens is that the idea is that the waiters and servers will be paid more if they do a better job, which isn't always the case because sometimes a lot of people are cheap, so they just choose not to pay the tip, or they can't pay the extra money for the tip because the tip is added on top of tax because you pay for the regular bill and then you choose if you want to pay for the tip. But the way that tip is usually paid is that there's a certain conventional percent, like say 10%. 10% is a popular tip in America for servers. So 10% of whatever the final price is after tax is what you pay for the servers. And that is what they live on a lot of the time. In other countries, like in Germany, I know for a fact, they do not tip servers. The servers get paid well, so the tip isn't usually appreciated. But for other professions, it varies depending on the nature of the work. So clarify this, tax is by a percent and tip is by a percent, or it could be by a certain amount. Like you could tip somebody and just give them like spare change that you have, like a spare couple of dollars you have, or if you get a haircut, you could just tip the worker $10 or so. So that is how tips generally work. So to overview, what happens is that a discount is when a price is lowered by either a percent, an amount, or buy one, get one free. A tax is an increase of a percent all around usually. And then tip is either you pay a certain percent or you pay a certain amount, depending on the work. And we'll go over all of these calculations. For now, it is about 1 o'clock. I mean, not 1 o'clock, 2 o'clock. So we will take a short break. Okay. So far, we went over exchange, referring to discount, tax, and tip. This is how we generally apply. This is what we generally apply to exchange, at least commercially, what we would most likely have to deal with in our normal lives. So discount would refer to things like when we go to the store and when we are at restaurants. Tax would refer to, it would apply to everything that we spend money on, and tips would apply to when we go to restaurants and we get certain services where certain people might be paid less. So we'll go over how we apply. So let's erase this for the time being. There are a couple terms that we should go over. There is price, which we refer to as the original price. When we say price, we're generally referring to the original price, as in the number on the price tag. Now, the price on the price tag can vary a bit. Now, commercially, the price doesn't necessarily matter to us because, well, the price matters to us in the sense that it is the base of our calculations in what we are going to pay for the product. But the price later on will be more so relating to businesses and in the economics behind it. But for us, the price would be the number on the price tag. And the number on the price tag can vary on whether it is pre-tax or post-tax. Pre-tax, having the suffix pre, meaning before, refers to the price before the tax. In that case is when you will have to apply the tax to find the final price. Sometimes the price in the store has the final price on it already. The final price is what we pay. It is the last number and the end of the calculation. The final price is when we have our regular price, we apply our discount, our tax, our tip, everything, the final price. Now, sometimes the number on the price tag is the final price, but that depends on if they apply the sale, the tax, or the tip already. So you have to keep that in mind, whether it is pre or post tax. The final price is what we are trying to find in all of our calculations usually, unless we have a problem that asks us to find the original price or the tax rate or such based on the information we're given. Now, aside from the final price is the sales price. The sales price is more specific than the final price because the sales price is the price of the good after we apply the discount. So it is almost exclusive to when there is a sale and a discount that we apply to the price to get the sales price. Sometimes the number on the price tag can be the sales price if they already apply it for us. Sometimes they'll do this by having the regular number like say $4.99, but then they'll cross it out and they'll say now $3.99. Sometimes this will happen on the price tag, and this will be the sales price because it is the price after the discount. So the sales price is the price with discount. So the price being the number on the price tag, the final price being what we pay, and the sales price being the price with the discount. After that, I think the last term you might need to know is the tax rate. The tax rate being the percent tax. So this varies on location. For instance, in Maryland, it is 6% tax rate. Or in other states, it could be 10, 7, 15, 8, etc. So the tax rate refers to the percent of tax. The percent of the price added on for tax. Now, with this, we can briefly go over how we calculate each. To calculate each, we mainly rely on percentages. Now, percentages revolve around the word percent, stem from the word percent, where percent is per, meaning multiple of cent, which means 100. Percent meaning multiple of 100, 100 being numeric value 100, and multiple being that multiple hundredths. So when we say percent, we say a certain amount of hundredths. Now, cent means 100, but in this context, percent means multiple of 100, so it is in hundredths. So a certain number over 100. So if we were to say 50%, it would be 50 multiple of 100, so 50 over 100. Or 50 per 100. That is the ratio that we get from this. So the percent is what we are going to be using for most of these. So at the store, what may happen is that you will see a sign that says 50% off. And the 50% off refers to whatever item is under the sign usually, or advertised on the sign. So if you had bread that was $400, if the sign says 50% off of the $400, that means it is 400 minus 50%. Or in other words, 50% off 400. And the way this would work is that you have to find what 50% of 400 is, and you have to take that away from the 400. And that will be 50% is 200, and you take away 200 from 400, and you get $200 is the sales price. Now, there are multiple ways of looking at this. If you recognize 50% as 1/2, (50% being half, that means it is taking away half of 400, or it is halving 400. So it would be 400 over 2. But the most efficient equation that you can use to apply it is that the $400 being the original price, or just the price, is 100% of itself. So $400 is 100% of itself. In this equation, multiplying 400 times 100, because 100%, because 100% is just 1, then that means this is just stating 400. When you subtract 50%, what you're doing is you're subtracting 50% from this 100. And what this means is that when you do this math inside of the parenthesis, you get 50% times $400, or 50% of $400. That is what this equation means. So when you apply a discount, here what we'll do, put this work to the side. $400, 50% off. We'll put our work here and say that what we did is that we did $400 minus 50%, or $400 being it's 100% minus the 50%, so that it is $400 at 50%, or 50% of $400. So what we'll remember is that the way to apply discount is that the price times 100% of itself minus the discount percent equals the sales price. If you remember, the sales price being the price after sale. So when it comes to the buy one get one free and the solid price, it works in essentially the same idea. If you have a numeric discount, so it's just a certain amount, then you just take your regular price and you take away the discount amount. If it's buy one get one free, then all you have to do is just figure out how many you have to buy. So saying N1 is the amount of things that you have to buy over the amount of things that you get, being N2, whereas N2, if it's buy a certain amount, get one free, it would be N2 is N1 plus 1. So if you have to buy 6 to get one free, then that means that the price is effectively N1 over N1 plus 1, which is you buy 6 if you have to buy 6 to get 1. So it would be buying 6 over 6 plus the 1 you get for free, meaning that the effective price would be 6 over 7. So that would be what the actual discounted price would technically be if you bought in those terms. Now, tax works in almost the exact same way as the discount. All the tax does is that it just adds to the percent. So when you get the sales price, that is when you add the tax. So our sales price is $200. So we'll say our price equals that, and our sales price equals that. If our tax percent, T, was, let's say, 6%, here's what we'll do. We'll say that the since tax is added on to the sales price, we have our $200 plus the tax rate of 6%. So $200 plus the tax of 6%, which is equal to our final price. And what we can do is that we can try and find 6% of $200, which is $12, and then we add it on to find the final price, or we do the same thing as we did over there, and we take the sales price and then we multiply it by its 100%, and then adding on the 6% of the tax to get the final price. So in other words, it is $200 at 100% plus 6%. So that would be 106% to get our final price of $212. And the way that you would find this 106% is because 1% is equal to, as we said before, 1 over 100, but also in decimal form, 0.01. So multiply 106 by 0.01, and we get 1.06, which we multiply to the $200 to get 212. So this would effectively be $200 times 1.06 to equal the final price. And we did a similar thing here where we said 400% at 50% is dividing in half, or in other words, 0.5. And that is how we did that. So for the sales price, it is using this equation, and for the tax, the final price with tax, it would be the sales price or regular price at 100% plus the tax percent to equal the final price. So you can either use the sales price or the regular price. Now, tip is the easiest one of all. We don't really need to go over it that much. Tip is at whatever percent you think is good. And what you do is that you take a certain percent of your final price and you add that much money to the bill and you give that to the waiter. So if I were to pay $200 for food and it was served to me by a waiter, if I were to say that 10% is a good tipping rate, then that means I would take 10% of $200 and I would add that to the bill and give that to the tip, to the waiter. That's the tip. So that is generally how the price, the sales price, and the tip works. So all you need is these two equations to do it. It is for the sales price, the regular price times its 100% minus the discount rate, and then you apply the math. Then for the final price for tax, you apply whatever price you're at, and you add to its 100% the tax rate to get the final price with the tax. Now, this is mostly what you have to take into account for exchange until higher level stuff in microeconomics and such. After this, we can briefly go over profit and loss and revenue. It's very simple. Revenue is how much money you bring in. So revenue is dollars brought in. So a good way to apply this is with exchange. So saying that if you were to sell a marker, let's say, for $100. So if the price of a marker, if price equaled $100 for a marker, revenue equals $100. It's simple as that. If you sell the marker for $100, the revenue is $100. Next is cost. Cost and profit go hand in hand. Cost, revenue, and profit. Cost is how much money it costs to make the revenue, in a sense. So markers have to be made, and the markers have to be made from materials that are transported to you, and the materials have to be made. So cost refers to the amount that you have to pay in order to make the material and transfer it to you and to turn the material into marker in this instance. So let's say after all of that, the cost of making the marker is equal to $50. So cost is 50% roughly, because revenue is $100 and the cost was $50, and that means the cost is about half of the revenue in this case. So cost So let's say cost is C. Cost equals $50. Now cost is probably when you add up a bunch of different costs together, because there's a lot of different things that go on depending on what you're responsible for. Because some people what they do is that they buy the markers and then they sell them at a higher price. This is called being a middleman, because you don't make the markers, you just get them and then you give them to other people. That is what being a middleman is. Places like other places like Office Depot, what they do is that what the way it used to be is that people used to sell paper to middlemen who distributed it to stores or sold the paper to other people. That's middlemaning, because what they did is that they bought the paper from the paper mills, and then they took the paper and they sold it to other people. Sometimes what people that's what cost can be, because they can just pay for the paper and then that would be their cost. A mill can sell their paper directly to the people, and their cost is taking account the cost to make the paper and to transport it. So their cost would be lower than the middleman's cost because the middleman has to transport it to them and then transport it to the people. So cost can be a bunch of different other complicated things, but the idea is the cost is just how much it takes to make something. So this is how much money you spend on getting the marker, and this is how much money you spend on selling them. This is the amount of money that you make from selling the marker. So pay money to sell. So cost is the amount of money you have to pay to sell. Revenue is the money that you bring in from selling, in a sense. Profit is the amount of money that you get to keep. So profit is simply the revenue minus the costs. That's it. So it is the amount of money that you make from selling the marker subtracted by the money that it costs, to sell the marker. So in our example, cost equals $50 and revenue equals $100. So our profit would be revenue minus cost, which would equal, in this instance, $100 minus $50, which would equal $50 profit. So it's that simple. Now, usually you'll have revenue. Revenue is probably the easiest one because revenue when you're selling something, revenue is simply how much you sell it for. That's it. Cost is the most complicated one here because cost, you have to calculate the cost it takes to make something, to transport it, to stock it on shelves, and other things. So cost is where all the complicated stuff comes from. Profit is the easiest because it's the revenue minus the cost. The idea in consumer arithmetic is for a seller to maximize the revenue and minimize their cost. This applies to selling and your personal finance, things like that. For example, let's say revenue is how much you make from work. That is your salary. So if I work a living, let's say I make $10,000 a year. If I make $10,000 a year from my job, that is my revenue, unless I have money coming in from other places. But most people get the revenue exclusively from their job. Cost, for instance, for me, while my revenue would be the money from my work, the cost would be gas money to drive to work, all the things I spend on myself, the food I have to buy, paying the bills for house, things like that. So in life, people want to have the highest revenue possible while spending the least amount of money to get the most profit. That is generally how it works. If your profit is negative, that means that your revenue is less than your costs. So that means that your cost is bigger than your revenue. So because it's revenue minus cost, that's when your profit would be negative, and that would be loss. So loss is when profit is less than 0. That is when you're losing something. Because let's say I sold a marker for $50, but it costs $70 to make. That means it is a revenue of 50 minus a cost of 70. That would be a profit of negative $20. So that would be a loss of $20. So that is so that is how revenue, cost, profit, and loss work. You'll get the hang of it almost immediately when you do work and that sort of thing. And with this knowledge, you can use this to manage your own money. You can identify where your revenue is from, try and see how you can raise your revenue, and you can see where your costs are from and try and lower them. And you calculate your profit and your loss based on that. Again, revenue is the easiest because usually you can see what your revenue is from what your salary is. And you can try and raise your revenue by getting a raise at your job or so forth. Revenue is easy. Once again, cost is the hardest part because cost you have to calculate from like how much you eat, how much it costs to drive to work, other bills like electricity, water, buying yourself toys, TV, internet, insurance, if you have hospital bills, if you pay for other people, dependents, taxes, things like that. So a lot of the times in business, the main thing that people look at is the cost because of things like that. And cost for you is other people's revenue, because if I'm paying the bills for electricity, the bills I'm paying is the revenue of the electricity company. So cost is really cost is the main driver because cost is other people's revenue, and it shows like all of the different things that go into making something. So that is simple consumer arithmetic. And I think with that, we can end class for today. I will upload this on the YouTube channel and we'll go from there. All right, have a good weekend, all of you. Stay safe.